Hey everybody, back with another dividend analysis, and today we're going to be looking at PetMed Express Inc., or very simply Pets. Wanted to take a look at Pets because they did come up when we did our screener for our Building a Better ETF video, and there were a couple questions about them in the Discord, so I figured it wouldn't hurt to do a slightly deeper dive onto their dividend. As always, we'll start by looking at the yield, currently sitting at about 5%, doing more than 3 times, getting close to 4 times what you'd be getting from the S&P from the wide market, so pretty good there. And you're not in one of those high dividend yielding categories, sectors like energy or REITs or something like that, so even more diversification for something of such a high yield. We'll go and look at their dividend history. We can see currently our last dividend paid out in November was 30 cents, and going back over 10 years, 12 years really, we were getting 10 cents. So over the last decade, more than the last decade slightly, the dividend has increased by, 3 times, which is great really when you think about it. You're not going to find 200% dividend growth in a stock over, right around a decade. So amazing there, but can they support it? That's the big question going forward. Are we going to keep getting these, 1, 2, 5, 3 cent increases, or is it going to slow down, or are they going to be able to keep doing it, or possibly even increase it more? We'll start by looking at the financials, and as always, we start with our cash flow. And we can see that over the last 5 years, our cash flow has been incredibly flat, really doing about 36.5 to 37 million, with a slight misnomer here in the 2019 year. But yeah, very, very flat at $36 million. That gives us a payout ratio of free cash flow of 67%. That's not bad by any means. It's in our acceptable range of 75%, but with something that has free cash flow that's this flat, we'd really like that payout ratio to be well under 50% so that there's room to grow. They do still have a little room to grow if they raise their dividend by another 1 or 2 cents over the next few years. They're still going to be well under that 75% mark for their free cash flow, but we really do need to see some free cash flow growth here. If they can get to this 45-ish to 50 number, over the next couple of years, then that free cash flow is really that ratio is going to be a lot better for the free cash flow, going to allow for increases in the dividend there. So keep an eye on that free cash flow if you're looking at this. If you're already invested in this, you really need to see this number start to increase past the $36 to $37 million range. Next, we can take a look at our income, and we can see that our income has been a little bit better, going from 24 million up to 30 million, but that does give us an even higher ratio for our payout of income at 83%, which is above our acceptable range. 83% is definitely pushing it, especially with this 30 million number. If they were at this, $37 million number that they were a couple years ago that their cash flow's at, this would be a little bit better. Of course, those numbers will tend to normalize over the long term, hence, having 37 in one of these years when we had 36 in another. But this income also needs to increase. We need to see that number get up to that 40, 45, $50 million range so that payout ratio gets well below 75%, hopefully down below 60 or 50%. So keep that in mind. We really do need to see some growth here in the income and the free cash flow, or those dividend increases are going to have to slow down or stop altogether because the company isn't going to be able to keep raising it. So just keep that in mind. Again, if you're looking at this, we need to see those numbers, that income and that free cash flow, keep going up for those dividend increases to keep coming. So what does Pets do? Pretty much, they do pet medications, treats, nutrition supplies, anything anyone's pet needs, they're going to be able to cover it, things of that nature. One other thing I wanted to look at was their balance sheet, which is one of the really shining spots here. We can see their total current and total assets both at around 160 and 190, but their liabilities are almost non-existent. As we can see here, total liabilities 46 million, total current liabilities 45 million. They have almost no long-term debt, sitting at right around $1 million. So that is one of the good things. As I did bring up this company when we did our Building a Better ETF for an interest rate environment, if there are interest rate increases, they have essentially no long-term debt, so that shouldn't affect them at all. This isn't a company like an AT&T or another company that's underwater on their current liabilities while also having massive total liabilities, so that an interest rate increase could hurt them in the short run and possibly the long run. Here, debt isn't really an issue. If you're looking for dividend companies in this definitely rising interest rate environment we're going to be seeing in the next few months, this is the kind of balance sheet you want to look for. A company with plenty of cash on hand to pay off all of their debt, or at the very least, total assets that can pay off their total debt while still being above water on their current assets. So keep that in mind. That's one of the reasons I wanted to look at this, one of the reasons why it got through the screener, even though its free cash flow was very iffy, its income was very iffy, being stagnant. That balance sheet is really nice, and companies with strong balance sheets don't tend to go out of business. So worst case scenario, you do lose those dividend increases, or there's a dividend cut, but the company isn't just going to go bankrupt or something, because they just have enough money to weather the storm. So just keep that in mind again if you're looking at something like this, or if you're looking at other dividend companies in the current rising interest rate environment. Balance sheets like that are definitely something to look for. So the big question is always, should you be looking at this? Is this something for you? From the appreciation side, as we saw, 200% over, 12-ish years is great. You're not going to find a ton that do as well or better than that. The problem, of course, is that free cash flow and that income, particularly the very flat free cash flow. If you can see those numbers start to increase, even if it's only a little bit, even if they're going from, 35 up to 36, then 38, then 40, then 42. If you can get years like that to start building on each other, $1 to $2 million increases every year, that's perfectly fine. They're going to be easily able to maintain the current distribution and probably give you those 1, maybe 2 cent increases going forward. So just keep that in mind if you're looking at dividend appreciation. From the yield side, it could be a high yield addition to an appreciation portfolio. If you have other appreciation stocks in there, if you're running something like an SCHD, if you built an ETF like we did with our Build a Better, or you just have dividend growth stocks in general, adding something like this in to some of those smaller yield dividend growth stocks, those stocks that have a 1 or 2% or 3% yield, but they're still growing their dividend. This could be something that could get you a little bit more yield into that dividend growth while still likely or hopefully growing that dividend. From a high yield perspective, if you're one of those really high yield investors, again, this could be a little bit iffy because of that free cash flow and that income, but it's definitely not the worst choice out there. Just looking forward, make sure that you're tracking that income, tracking that free cash flow, making sure the balance sheet stays as healthy as it is, stuff like that. And as always, I thank you for watching, and I'll see you next time.